Welcome once again. Let's continue chapter 19, that is meaning, objective and terminology of accounting. I have already discussed the meaning of accounting and bookkeeping. Let us discuss today the distinction between bookkeeping and accounting. Let's begin. Now, you can see three columns. First is basis of distinction, on what basis we are differentiating. Bookkeeping and accounting. First, the basis of distinction is nature. The job of a bookkeeper is clerical in nature, whereas the job of an accountant is analytical and imaginative. Scope: bookkeeping is concerned mainly with the recording of transactions, whereas accounting involves classifying, summarizing, analysis and presentation of information. Stage: bookkeeping is the primary stage of maintaining accounts, whereas accounting is the secondary stage. That is why it is said that accounting begins where bookkeeping ends. Results: bookkeeping merely reflects the transaction as they occur and do not provide any conclusions. Accounting shows the net results and financial position of the business. Basis: in bookkeeping, the transactions are recorded according to the principles of accountancy, and accountancy determines its own principles. Authority level: the work of bookkeeping is performed by the junior staff with very less authority, whereas the work of accounting is performed by the senior staff having more authority. Next, I move on to the objectives of accounting. It is one of the very important part. First objective of accounting is to maintain records of business. So, maintaining records of financial transaction is one of the primary objective of accounting. It involves identifying the transaction of financial nature, measuring them in terms of money and recording them in the books of account, and classifying them under appropriate heads. Second is calculation of profit or loss. Another objective of accounting is to ascertain net result of day-to-day transaction. Every business firm wants to know whether it has earned profit or suffered a loss during the period. For this purpose, a statement called income statement or profit or loss statement is prepared. In this statement, revenue earned and expenses incurred on the transaction of the period are recorded. It also gives the result as net profit or net loss. In addition, information is available about opening and closing balance of stock, of goods, purchase, sales and other significant factors leading to profit or loss. Third is depiction of financial position. A business firm also wants to know its financial position at the end of a particular period. For this purpose, a statement called balance sheet is prepared. It shows the assets and liabilities and capital of the firm. A doctor can know the health of a person by feeling his pulse. Similarly, one can know the financial health of a firm by looking at its balance sheet. If its assets exceeds the liabilities, the firm is solvent. Otherwise, it is insolvent. So, if the firm's assets are more than the liabilities, then its state is solvent state. Otherwise, if its liabilities are more than assets, then it is in an unstable position. Fourth, to make the information available to various groups and users. Another purpose of accounting is to communicate the financial facts about the firm to various interested parties. Example, the owners, the investors, the creditors, employees, tax authorities, government, research scholars, etc. On the basis of such information, these users of accounting can take sound and realistic economic decisions. From a study of accounts, a management can know the result of its policies. It can decide upon the future course of action, such as increasing the scale of production, introducing new product, or changing the selling price. Lenders and investors can judge the earning capacity of the firm and decide whether or not to invest or lend more money. Shareholders can make an estimate of the efficiency of management and decide whether or not to sell their shareholding in the company. So, these are the stakeholders, internal and external, who require information so that they could make a sound decision. Next, I move on to the accounting cycle. Accounting cycle refers to the complete sequence of accounting activities. It begins with recording of the transaction and ends with the preparation of balance sheet. It consists of the following stages. First is preparation of journal, that is the primary record of financial transaction. Journal, which is also known as book of original entry. In a large enterprise, separate journals are kept for recording different types of transactions like cash book, purchase book, sales book, purchase returns book, sales returns book, bills receivable book, etc. These books are called subsidiary books. Next step is posting these journal entries in the ledger. The entries recorded in the journal, which are transferred periodically in the accounts, known as ledger. This is known as posting of the transaction in the ledger. Ledger is also called the principal book of accounting. At the end of the year, all accounts in the ledger are balanced. Balancing means determining the difference between the debit side and the credit side total of the account. Third is trial balance. The balances of various accounts appearing in the ledger are transferred to the trial balance. Trial balance is a statement containing balances of all the ledger accounts. The total of debit balance must always be equal to the total of credit balance. This is also known as the tallying of trial balance. Fourth is income statement. At the end of the year, an income statement is prepared from the trial balance. Income statement, which is also known as trading and PL account, profit and loss account, is prepared to determine the net profit or net loss during the year. Fifth is balance sheet. It is a statement determining the position of the assets and liabilities on the specific date of a firm or an organization. It is prepared to know the financial position of the business. Net profit or net loss ascertained in income statement is transferred to the balance sheet. So, in total, there are 6 stages. Just you can see this diagram below. First is the transactions which take place. Second, posting in the journal. Then, from the journal, the posting is made to the ledger. Then trial balance is prepared. Then trading account, which determines the gross profit. Next we have profit and loss account, which determines the net profit or net loss. And the last is balance sheet. It is a statement determining the position on a specific date It's a statement determining the assets and liabilities of a business concern. And the sixth is opening the new books next year. The balance appearing in the balance sheet are transferred in the new journal of the next year. The same process is again repeated. So this entire steps is termed as accounting cycle. Till here it is clear. Read your textbook for better understanding. Thank you for today. Have a nice day ahead.